After the year 2000 and the dot-com boom and bust, we looked back in the rearview mirror and it was obvious. The market had been so overvalued. Suddenly, everyone was a genius. There's just one problem. Just like with the subprime crisis, few were screaming about the tech bubble. Why? Because nobody wants to stop the party, nobody wants to take away the punch bowl, nobody wants to cut the music. But at some point, people need to realize the extreme devastation that occurs when garbage is suddenly reasonable and average is suddenly spectacular. You came here for the truth, so let me unveil that for you. Today we are going to talk about pigs. That's right, pigs go to slaughter. This is an interesting conversation because it's very touchy. People have their 401ks, they have their retirement savings, they've gone into excessive leverage, they're using options, they're using margin, they went too far, but as long as the Federal Reserve keeps pumping, as long as interest rates remain low and then eventually go into the negative, and as long as they're willing to make the US dollar confetti, everything is going to be just fine. Bank of America put this chart out, and you could see growth sectors are greater than 50% of the S&P 500 market cap for the first time ever. It is beyond excessive, but it's been growing for years. This was the case back in the year 2000 leading up into it, and we've actually accelerated beyond that. What has happened here in 2020 has never been seen before. The amount of money that's been flooding in to these few stocks is unbelievable. It is just unprecedented, and there are interesting familiarities with what we saw back in 2000, but also back in 2008. It's like a double whammy. Which one is going to hit first? I don't know, but the tech stocks are going really through the roof today. But we're also seeing the derivatives being an issue, commercial mortgage-backed securities being front and center. There are new things that have piled on, of course, with the excessive corporate debt. So many different issues today, and when we have one accident, it all begins to unravel. Look at this total market cap comparing Apple on the left hand side there, and on the right hand side, precious metals industry. Apple, it's over $2 trillion right now. And then you look at the precious metals industry at 600 billion. 3.5x. You can argue any way you want who's more valuable and this and that. We've gone beyond the valuation for this company here. It is truly excessive. Doesn't matter how many iPhones they're selling. It doesn't matter what kind of business they're getting into, Apple Arcade and all of this other thing. For the most part, there is no justification for what we are seeing in this bubble today. It doesn't have anything to do with this particular stock in general. There's just a lot of money floating around, and it's finding its way into equities. I've got more information for you on that in today's video. NASDAQ Composite Index, you could see what has been happening here in 2020. The NASDAQ has roared higher. At the bottom, we have the advanced decline accumulation, and you could see that we've got a big problem with the breadth. That is never a good situation because that tends to lead to a decline in the stocks. We'll see what happens. But of course, when you have a narrowing band of stocks that are rising, a narrowing band of interest, that presents itself with a big problem. You never want that. You want there to be healthy stocks all over the place, all different sectors. But today, there are fewer and fewer stocks that are doing well, not just in their performance in the market, but we're talking about the actual companies themselves. The profits are down. They're having big problems. You know what's going on in retail. You know what's happening in the travel and tourism, hospitality industries. There are so many that are getting crushed today. Even those in, for example, oil, even though the price has found its way back up to where it was previously, it's still not good enough. There are many industries that are suffering for different reasons, and of course, there's no amount of money that can be printed that would do anything to fix it. Here's the Dow Jones, and what we are looking at is 2009 to 2020. That's the yellow line, and the blue line is 1919 to 1932. And they are, of course, mirroring these two. There are many differences between them. It's a different scenario altogether. But I like to see it just to give myself perspective, because if you look at what happened leading up into that moment, 1929, everything was growing. It was the roaring 20s. You know as well as I do how the performance of the stock market was leading up into this moment, just like what we are seeing today. Everything is great. Everything is fantastic. We had a similar issue going into 2018. What happened in 2019 as well? There have been smaller examples along the way. You don't have to compare necessarily 1929 to what we see today. There are so many that happen, and the preparation for it is never there because people are thinking, I don't need to worry. I don't need to get that insurance. I don't need to have a hedge because the Federal Reserve is my hedge. I thought this was really interesting. Sovereign wealth funds stampede into stocks outside of the US. Outside. We haven't heard that for a while. Sovereign wealth funds poured a net $7 billion into stocks during the second quarter, the most in several years, with the bulk outside of the United States. That was far short of the flows into US equities in the first quarter of 2020. There's a chart down here. I just wanted to point out the fact that when we see these disparities, we have to start looking into why. I always like to point out the data as soon as I get it, and then when I get further evidence, when I get further information, I like to bring that to you because we start to build a case. Here you can see in the billions of dollars, it's just showing you all global equity, and then below that is all US equity. So that's 8.4 versus 0.7. Big difference there, that's for sure. It's only one group, right? This is looking at sovereign wealth funds, but there's a lot of money, a lot of analysts, a lot riding on these sovereign wealth funds. I would love to get some data from the EPFR. As soon as I have that for you, definitely will bring it around. It's important to see where the money is flowing in and out of at any time. Warren Buffett's Berkshire Hathaway buys stakes in Japan's 5 leading trading companies. You got a 5% stake in them. Each would be valued at roughly $6.25 billion. So there haven't been many purchases by Berkshire Hathaway in the last little while. We saw what he did, shoving the banks to the side, buying into gold mining a little bit. Definitely some big changes going on here in what has been a relatively quiet span throughout this period. I find the strategy to be very interesting that Warren Buffett, Charlie Munger are responsible for with Berkshire Hathaway. They would rather buy a company that is fantastic at a good price than buy a mediocre company at a fantastic price. So they're not necessarily looking for the best price. They want to know that this company is sound on many levels. I know that for the majority of people, all they have, for instance, is they look at Amazon, they say everybody orders off of Amazon, I order off of Amazon, my neighbor orders off of Amazon, Amazon is growing, fulfillment centers are everywhere, I'm going to buy Amazon stock. That works for people, but not when you have a lot of money riding on it. You're not going to see a multi-billion-dollar company riding on those simple measures. So when people are trying to look at Warren Buffett, or they're trying to look at Seeking Alpha, or wherever the heck they're getting their news, you have to take it into context. If you want to try and get all 7 shares of Amazon, you have to understand who you're up against. Ohio Pension Fund adds gold allocation to hedge risk and inflation. The $16 billion Ohio Police and Fire Pension Fund approves a 5% allocation to gold to help diversify its portfolio and hedge against the risk of inflation. You don't hear this too often, that's for sure. I love how right down here they refer to it as the non-interest bearing metal. Why even bother mentioning that? It's like they had to stick that in there. It's strange the way that these different companies, this happens to be Bloomberg, for instance, or CNBC, they're always hating on something that they do not make money off of. Look, just report the news. Just report the information. Stop putting your bias in. Pinterest cancels huge San Francisco office lease in unbuilt project, citing work from home shift. They actually paid $90 million because of this. $90 million. So it's going to be this huge thing. Now everybody's working from home. They rather just pay the $90 million, forget about it. Now, whoever owns this building is in big trouble because they obviously thought to themselves, okay, great tenant. They'll be here for years. They get everything for the stakeholders. It'll be all good. But now something big has happened and they need to fill in that space. Are they going to bring the prices down? Probably not. They're going to do what's going on with New York. They're going to leave the stores empty. They're going to leave the stores boarded up. It's a disaster. And this, of course, has such a deep connection to what's happening with the derivatives. This article here is talking about a gas tax increasing in New Jersey. Wait a second, increasing taxation? Could it be possible? That's right, I can't believe it, but another tax being added on top. They are growing this particular tax here. They are adding new ones all the time. People are getting taxed out of this place, and this is one that is getting really out of hand. This is unbelievable because basically what they're doing is making people say, I'd rather just stay home. They are pushing people down. This is not a good thing. It's not going to fill the void. The way that the government looks at it is, we've got a problem. We've got a deficit. We need to fill the hole. Let's tax the people. They're taxing them right where it hurts those in the lower incomes. This is such a big problem, but they don't even realize it. Those who are driving to and from work, they're trying to make some money and it's getting more expensive to do so. That's why we've got issues today that cannot be resolved, but they simply make the situation worse. That's all for this video. If you found it informative, hit that thumbs up button. If you hated it, give it a thumbs down. If you want to learn how to sell stuff online, I have a free e-course for you. It's available at theamazongps.com. If you want to understand what's going on with the financial system, you need all the detail, everything from top to bottom. And these two books will give you that. Check them out at the link in the description. If you want the audiobook, themoneygps.com. Hang on a second, don't go anywhere. Have you seen this video? A lot of detail, a lot of good stuff. Definitely check it out. Click it. I'll see you there.